We're here to talk about the Silicon Valley real estate market and the greater Bay Area, 13 counties. We'll get back to this slide in a little bit. Here's the first summary slide. This is showing Silicon Valley, Santa Clara, Alameda, and San Mateo counties. We're starting off with inventory. This week is in the middle of the table. It goes back to the left 1 quarter, 13 weeks, and it goes into the future 13 weeks or 1 quarter, but only for the trend data, because obviously you don't have the current year data, which is the purple data, into the future. But it gives you an indication of which way the data is going to go. And you can see there's a dip here right on week 1. That's Labor Day. And Labor Day is as early as it can be this year. And so it's impacting it at the early side of the V. It's going to shift by as much as 7 days. Anyway, what you're looking at is the current data over here. Right now we're at 2506. Typical is 2600 listings. So we're actually short this week. That's a new shortage. But that's just because this is the holiday weekend. Next week, we'll probably have a slight surplus. Basically, we're having normal levels of inventory, and you can tell that because the purple line's been more or less on top of the gray line for the last 5 weeks. That would be the normal as defined by the past 10 years, 2015 through 2024, for this same week. The blue line at the top is the most inventory you'd expect, which is based on the 90th percentile for that same data set. And the red is the least amount of inventory you'd expect, favoring the seller, red hot marketplace, no competition from the other sellers. And so it's a hot marketplace, and that'd be the least inventory. The big takeaway, though, is notice that just a quarter ago, you had 30% surplus of inventory. You can see you were up here above the blue line 13 weeks ago. And now you have a shortage. We've lost 25% of the 130% of the inventory. So now we're at 95% of normal. So we're basically back to normal, but we lost that surplus of inventory. Doing the same thing with offers accepted. A quarter ago, we were at 2,300, which was 78% of where you'd expect it to be. We're now at 2,120, basically, and that's 85%. So the number of offers has gone up, and you can see the increase just in this last week that you've pulled away from the blue line. We've been following the blue line pretty accurately for 12 out of the last 13 weeks. And that's been really the story since the slowdown of 2022 is we've been missing about 20 to 25% of the marketplace just isn't there. We're clearly missing 15%. This could also be a holiday shift. So you can't put too much credibility into this until we look at next week's data. I would actually expect next week's data to be fairly constant on offers accepted. Buyers tend not to take the holidays as seriously as sellers do. Moving on to the number of closed transactions, you can see it's been sort of doing the trend of the number of offers, but delayed. In other words, the number of offers have been following for 12 weeks, the blue line, and the number of closings has only been following the blue line for about the last eight weeks. There's a 4-week difference. Guess what? That's about the length of the typical escrow closing. We were at 77%, almost matching. We're now at 74%. You can almost initially say, why can this be at 74% and this at 85%? It's because of that 4-week lag time. 4 to 6 weeks is the normal length of escrows. But anyway, we're clearly missing 25% of the closings. That's what the real estate industry runs on. Days of unsold inventory is the seller-buyer balance, and that's the supply-demand. How quickly is the market turning over? Quarter ago, you were at 58% of slower than normal. Longer number is a longer time to sell your existing inventory. Now you're exactly at normal, or not quite exactly, but 3% above. You can see the huge decrease. This is a combination of less sellers coming on the marketplace for a holiday weekend and the increase in the number of offers accepted. Both of those combine to lower the DUI. So the DUI is normal. You're now down to 41 days. Moving on to something that's a little easier for the layperson to understand is days on market. How long does it take 3 out of 4 sellers to sell their property? A quarter ago, we were at 26 days, which was 63% longer than normal. And you can see that was 63% longer than normal. Now you fast forward, you're way above the blue line, and it's the ratio between the gray line, which has also come up. You're now at 34 days. So that's basically a little over 8 days, 1 full week longer. But even though it's a longer period of time, percent of normal has actually decreased to 45% longer than normal. And that's because the gray line, the normal line, typically comes up at this time of the year. 3 out of 4 sellers are selling in basically 5 weeks, 34 days. Typical is just 3.5 weeks. So clearly taking longer. The longest you'd expect based on the past 10 years is only 31 days. We're clearly longer than that. But also, if you look back historically, the last 10 years have been fairly aggressive marketplaces. So one of the things we have to keep in mind is, maybe the past 10 years isn't a great benchmark. It's not been really typical. Ask price reductions is sort of an interesting thing. Sellers do their homework before they put their house on the marketplace, and so they determine what they think the reasonable expectation, reasonable market value of the property is, and then they test it out and put it on the market. And price reductions, seller price reductions before the offer comes in the door, is an indication of how well their research was in line with the marketplace. So if the market is going down, sellers tend to overestimate the market, and we tend to have higher price reductions or more frequent price reductions. If the market's going up, even if the sellers misread the market a little bit, the market catches up and that property sells without the seller doing a price reduction. So the magnitude and frequency of price reductions is an indication of how the market's doing. A quarter ago, we were double the price reductions that we normally are, but that was only 1.1%. So normally you're taking about 0.5% price reduction. We were a little over a full percent. You can see that that's actually increased. It's on a magnitude basis. We're now taking a little over 1.5%. So it's almost a 50% increase in the size, the magnitude of that reduction. But compared to the frequency of normal, it's actually decreased from 223% down to 181%. So still a larger price reductions than you'd expect. And you can see the typicals over here is 88%. You're not quite double that, which is why it's 181%. Then moving on, not as a leading indicator, but more of a point of interest, is overbids. Overbids are the amount of competition a buyer feels when they're going in and writing off their offer. And this is just in percent. Typical overbid a quarter ago would have been 7.7%. A quarter ago this year, we were only at 5.9%. So you're missing 1.8%. Currently, overbidding would normally be 5.7%. We're only at 3.2%. This is the average overbid, not the median, but the average overbid. So you're missing something like 2.5% of the normal overbid. You can see it ranges anywhere from 3.2, which is a cool marketplace, which you can see we're right there on the blue cool line, all the way up to a competitive marketplace of 7.4% overbidding for this week. And this week is defined by March 1st being the first week of the year, and then counting forward 7 days at a time. Here's looking at the number of inventory, active inventory, number of offers, and days unsold inventory long-term compared to normal. So if the index was normal, it'd be right on the gray line at 100% of normal. Starting off with the inventory in the purple line, you can see inventory has been getting closer and closer to normal. You can see we dropped from about 102% just last week now down to about 96% of normal. So you can see inventory is now slightly below the normal level of inventory. Going down and looking at offers, you can see that offers increased. Both of these combined to have days unsold inventory, the supply-demand balance really plummet, and again, getting closer to 100%. So both your days unsold inventory and your inventory are close to 100%. Your offers are still lagging, but at 85% of normal, closer than we have been, mostly down here around 80%. You can come back and see 2023 was about 70%. 2024 and 2025 have been roughly 80%. Here now is looking at just each component, and now you can start seeing the vertical drop in inventory. This is the drop in inventory based on the buyers still acting normal during this past week, eating up the inventory that was on the marketplace, and then sellers not coming on the marketplace this weekend because of the Labor Day holiday. You can see there was a July 4th impact. You can see the impact of Labor Day. Every holiday negatively impacts real estate activity because real estate is an optional event. And if there's other things going on, people are doing that and not focused on real estate. So you can see the trend is pretty close to normal. It is spread out a little bit because Labor Day moves 7 days, so it can go from 1 week of impact to the next. But, you know, it's doing basically what you'd expect it to do. Here's compared to normal. So if you were having a normal marketplace, you'd be right there. You can see the surplus earlier this year. We were almost 40%, 38%, I think was the number above normal. You're now down about 95%, if I'm not mistaken, 95% of the normal level of inventory. Same thing now with the number of offers. You can see the offers have been increasing. We do have a little bit of a lull in August. So now that we're into September, and it looks like the lull actually happened maybe 2 weeks ago, we've been gaining offers. Whether this continues up or not, you can see the spike in the normal trend, you can see the spike in the hot, and you can even see the spike in the cool trend. So the fact that we're going up right now is not surprising. And this is, again, the number of offers accepted in the past 5 weeks. This is on a percentage basis, this is where you start saying there's been a shift in the marketplace. Because if the market was behaving like it normally does its normal cycle, you wouldn't be changing the percentage. Whatever 100% is normal. If you had more offers, you'd be up here at 120%, but it would be flat. If you had less offers, you'd be down here at 70% and normal. And you can see that back before pandemic, yes, it was bounced from week to week, but you stayed pretty level. We've been getting more volatile recently, and it seems like every year we get more volatile, just like the stock market seems to be getting more volatile. One thing to keep in mind too is on the right-hand side of this green vertical line, the x-axis is about twice as spread out as it is before. This is 1 year from here, right there, to right there is 1 year. Before, to the left of the green line. To the right of the green line, it goes from there all the way to there. And the purpose of that is to be able to show you all 10 years of data, which is 2024 back, that make up my data set for the median, and then to expand out for the most recent year and the current year, so you can see these fluctuations up and back and forth, which is part of the reason why these changes back here are so condensed. This is the days of unsold inventory now. This is, in my opinion, one of the key indicators, because it's a supply-demand balance, and in a free capitalist society, that's supposed to indicate what's happening with future pricing. You can see we rolled over, July 1st would have been back here, so maybe August 1st, and we started to improve. But then just notice this improvement this last week. That's the most significant improvement. And again, that's because the sellers didn't come on the marketplace. So we now have a lack of inventory for this weekend. And for whatever reason, there was more offers last week than there had been. Here's the improvement just blown out on a percentage basis. So you can see you're getting back almost 100% of normal, slightly slower than normal. I think the number was 103%. This is the marketing time. This is defined by 3 out of 4 sellers selling. You can see it peaked just about 3 weeks ago, and we've come down. We're now at about 34 days. And again, this would be for single family homes in Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties. Here's on a percentage basis. You can see the improvement from 184% or whatever the number was back here only a few weeks ago, and it's been coming down pretty quickly. We had a little bounce up last week, and now we've come back down. And this is marketing time, so it's taking sellers roughly 45% longer than it typically does for Silicon Valley. This is the sellers that are taking the largest price reductions. I line up the sellers, I look at the 90th percentile. So 1 out of 10 sellers would take a larger price reduction than this. 9 out of 10 sellers would take a smaller. You subtract it off of 100 and you're at a 16% price reduction. So that's a huge price reduction. But you have to realize that sometimes people do their homework incorrectly. Sometimes the seller is adamant that they want to try a high price, know it's a high price, and reduce it fairly quickly. So the largest price reductions right now are ballpark 16%. Keep in mind the vast majority of the sellers do no price reduction. Something like 75% or more of the sellers didn't do no price reduction at all. Here you can see it's 40% more than typical. You can see price reductions have been going up, which would be a decreasing marketplace, because as you take more price reductions, that's an indication the market's slower. And we're not at record high levels, but the only extended period of time we were really at this level was after the 2022 price reduction. So that's somewhat significant in my book. And the fact that this is going up, it lags behind, because right now you would expect less price reductions with less inventory and more offers. But everything in real estate isn't in sync. We're not a perfect marketplace like the stock market's deemed a perfect marketplace. Here's the average seller's price reductions, and you can see that's only 1.6%. So that's much more reasonable, but that's because the vast majority of those sellers do no price reductions whatsoever. And you can see that you're sort of following the blue line. At the beginning of the year, we started off a lot better. We were basically taking normal price reductions. But then what happened was the market sort of softened, and sellers aren't quick to acknowledge softening marketplaces. So they came on the marketplace, and then they had to take bigger price reductions. This is compared to normal. So now you're taking a little bit larger price reductions. Normal would be up here. This would be the increase in showing you increase. I don't have a scale on this graph for some reason. The frequency of price reductions. So how common is it? Right now, you can see that 21.5% of the sellers are doing price reductions. So flip it around, 78.5%, more than 3/4 of the sellers do 0 price reductions. So that's why that average at 1.6 is so small compared to the 16% for the sellers that are taking the largest price reductions. Here's that frequency. It's 35% more common right now, so a third more common. You can see it was much more common just earlier this year. And you can see at the beginning of the year, we actually had less price reductions than normal. And all this data is comparing the same week to the same week. So you're trying to get rid of the weekly cycle, and yet the data still moves up and down. That is, this curve here is actually the improvement and decrease of the marketplace. And if you look at it, you can sort of almost see the trends. You know, here was, the market was getting red hot. We hit the pandemic. We slowed down the brakes while we were doing shelter in place. We came racing out. We had a super heated marketplace. We rolled over into 2022 and the market collapsed, or prices at least dropped. And look at that huge increase in frequency of price reductions. So it does actually trend the market fairly well. And that's one of the reasons I track this data point. Here's overbidding. This is a measure of the buyer's competitiveness. How much does the buyer feel he has to overbid to get a property? And you can see last week we were basically right at 100%, and we've turned around ever so slightly and gone up. And this is the median, which is why it's at 100%. The number that was at 103% was the average overbid. The average is going to be almost always higher than the median. I won't say always, because something could happen, but it should always be higher. So if it was a typical amount of overbidding, it would be right here. And I think that number was 5.5%. We were down at 3%, which is 2.5% below the typical overbidding, which is how you read this graph. So we're getting 2.5% less overbidding right now, which would tend to say that buyers don't feel the need to overbid, which would be an indication of a cool marketplace. Here's the frequency of overbidding. So we're at 52% of the sellers getting more than their asking price, up from about 51% last week. Still, for Silicon Valley, that's actually less than you'd expect. You'd expect Silicon Valley to be up here somewhere around 2/3 of the sellers, 67% of the sellers getting more than their asking price. So even though a lot of places in the country would say it's bizarre to have half the sellers getting more than their asking price, here in Silicon Valley, that's actually a fairly low number. Here's compared to normal, so you can see that you're quite a bit lower than normal. You're quite a bit less overbidding than you typically do. Less overbidding is a cool buyer's marketplace. Here now is my attempt of a price modeling. This 11.4% is becoming less accurate. That would have been good, you know, for a while with a little bump up here, but a more accurate price model is a two-step, where we were getting 12.1% appreciation from the 2015 timeframe up through the first half of 2022. And since the first half of 2022, prices are basically flat. Yes, if you buy here, you're paying a much higher price than if you buy here. But also keep in mind, this is not necessarily property values, but market mix comes in. If this is where more large homes and more desirable, maybe family-based, school-based homes are selling, and this is where the single person is buying their first starter small home where they don't care about the commute and the less expensive areas are increasing, whatever causes that, this could be just a shift in the market mix. And that does impact the data. And that's one of the reasons I believe in micro markets. When you start getting down to micro markets, market mix doesn't happen because you're comparing similar apples. And we'll get into that later in the presentation on a county basis, where the media talks about the Bay Area real estate marketplace. Well, that's made up of 9 counties, and each county is doing something that's different. So now what we're doing is we're looking at the 3 counties that make up Silicon Valley. We have Alameda County in the gray, we have Santa Clara County in the blue, and San Mateo County in the orange. You can see that San Mateo County actually set a record high level of inventory just earlier this year. Santa Clara County is close, but still below their previous peak. And I would say that Alameda County is very close to their peak. I would actually say their peak happened a little bit earlier this year than it typically happens, because you can see that this peak is typically happening sometime during third quarter, where this time it happened in second quarter. This is just the inventory level of the 3 counties. Here's the offers accepted. Santa Clara County, with less inventory, is doing more offers than Alameda County right underneath. I don't know if you can see, Alameda is at 800. Santa Clara County is probably about 840, 835. And then San Mateo County, being a smaller county, it's about 390. This is the days of unsold inventory, and Santa Clara County is the fastest at just over 40 days to sell your existing inventory. San Mateo County is at 48 days, and Alameda County is at 58 days. So San Mateo County is in the middle, with Alameda County being the slowest. Here's marketing time. Again, Alameda County is the slowest. Now in marketing time, this is sort of interesting. San Mateo County in the orange is a little performing slightly better, like 31 days versus Santa Clara at 32 days, even though the turnover rate for Santa Clara County was faster than for San Mateo County. Here's the price reductions. Look at this huge drop in Alameda County. So there was a huge increase in Alameda County. At the same time, San Mateo County is doing a fairly significant decrease in price reductions. So clearly a mixed bag, where Alameda County did an increase and San Mateo County did a significant decrease, and Santa Clara County is sort of more mild, but so also decreasing like San Mateo County. Here's the frequency. So the most frequent price reductions are happening in Alameda County. And keep in mind, that's only 23%. So that's less than 1 in 4 sellers are doing a price reduction in the most common county. Santa Clara County is right there at about 22%. And San Mateo County is doing the least frequent price reductions at 18%, which is less than 1 in 5. This is the magnitude of overbidding. Alameda County, that has the longest marketing time, the slowest turnover rate, has the most overbidding. The only logical explanation for that is sellers are reducing their price, triggering the larger number of price reductions, the larger magnitude of price reductions. They're overshooting where the market is. And so despite the property being on the market with 30 days, 60 days, the buyers are coming in and saying it's now priced below the market and they're overbidding. Santa Clara County, that's the fastest paced marketplace, actually had the least overbidding at just over 2%. And again, you could explain that by, Santa Clara County, they're coming out there and they're pricing the property well, but they're right at the market. So the buyers are not feeling that need to overbid. But to have a 2% at 2.5% overbid is still significant when the prices that we're talking about in Santa Clara County. Here's the frequency of overbidding. All 3 counties are essentially identical. It's somewhere around 52 to 54%. If you look at it, it does look like Santa Clara and San Mateo are the most frequent at 52, and it does look like Alameda County is highest at 54. So it's the largest magnitude and also the largest frequency. And the frequency could be what's making the magnitude the largest. Here's long-term appreciation. Notice Santa Clara County is coming down. A lot of this is market mix, and we might see that later on. It's getting less pronounced. But back here where we had this huge 120% appreciation since the last 9 months of 2015, no micro market area in Santa Clara County had an increase as great as the county as a whole did. That meant that more expensive homes were selling, less expensive homes weren't selling, raising the median price, but not impacting property values. This is based on the median price and not on property values, which is why market mix impacts this data. The other 2 counties are somewhere down here around 70% appreciation. Here's the sold price. San Mateo County is the most expensive. Santa Clara is second, and the more affordable is Alameda County. This is on log paper. I prefer log paper, but a lot of people prefer regular paper. So here it is. It is easy to read the numbers. Alameda County is at about 1,250,000, 1.25 million. Santa Clara County is at about 1,850,000, and San Mateo County is at easy 1.9 million. Here's the estimated payments. I'm using the current interest rate for high balance conforming loans. Jumbo money, which most people would be using in Silicon Valley, would be at a lower rate, but I haven't been able to find a long-term reliable source for jumbo money. So I use the high balance conforming number. It gives you a relative number, and it's going to be in the same order as price. But what this does is it sort of shows you the impact of interest rates on payment, which I believe that buyers are buying by more payment than they are price. They may go out and get qualified for a particular price range, but that's based on the payment that they can afford. Here now we get into the micro market data. This is a map showing the micro markets. There's 20 micro markets, 7 in Santa Clara and Alameda County, 6 in San Mateo County. Here is the inventory. You can see that we go from a high in San Mateo County of 107% to a low of 88, and well, I'll call it 90% in Santa Clara County. So if you're tracking Silicon Valley overall, you're at 96%, but you have a fairly significant range, and the range within each county is pretty significant. For example, in Santa Clara County, you go from 70% to 119%. That's why it's important to look at what's happening in the micro market area. Here's the same concept with offers. You can see across the board, we're blue. The only area that's red at all is Los Altos and Palo Alto, with 25% more offers than normal, and the rest of the area has less offers than normal. This is how you can have an increasing in median price without having an increase in property values. Clearly, Los Altos, Palo Alto pricing is more expensive than the median. If they're making up 25% more, and overall, the rest of the county has maybe 25%, maybe closer to 20% less offers, that's going to raise the median price. So that's the kind of thing that what I call market shift. Here is days unsold inventory, and this is compared to the all of these first three slides are comparing to the 10-year median. So we're sort of balanced. We have some areas that are faster than normal, but we have areas that are slower than normal. So you can see the areas that are slower than normal are the sort of the eastern side of Santa Clara County. The northwestern portion of Silicon Valley is the hotter area, and Alameda County is basically normal. Here's days of unsold inventory. So the previous slide was based on the 10-year median. So you were roughly balanced, with the differences that we talked about compared to the previous 10 years. But now this is raw numbers. So look at Pleasanton and Livermore. That's cool. Come down and actually look at what the numbers are. 117 days in Pleasanton, Dublin, 142 days. So, and that would be Livermore as well. So that's what this blue is. So they're actually fairly slow. And I think what happened there is a lot of people moved out to those areas during the pandemic when they didn't have to go to work so much. They now have to go back to work, and some people are selling and moving back because the commutes got to them. So you have this huge dichotomy where the bulk of Silicon Valley is actually still red hot. And when I say red hot, Santa Clara County is selling out in 17 days in Cupertino, 27 days in Campbell, 29 days in Los Altos. That's a fast-paced marketplace. I consider roughly 6 to 11 weeks to be a balanced marketplace. So you can have a fast-paced marketplace and still be cooler than normal. And until this last week, we were cooler than normal. We're sort of all close to normal now. But then you still have areas like this, Dublin, Livermore, Castro Valley, Pleasanton, that are slow, very slow. I would call that slow. You're taking 4 months and 5 months to sell your inventory. That's slow for my standard of Silicon Valley. Here's marketing time. Now you can see the marketing time pretty hot right here in Palo Alto and Los Altos. It's at 59%. We're now comparing to normal. So that's going almost half as quick as it normally does. But now look at the range. You go from 60, let's call that 60% to 152%. So it's taking 50% longer in Morgan Hill, and it's taking 50% less in Los Altos if you give me a little latitude. You come down to San Mateo County, it's not nearly as spread out. I'm seeing, 100% in Foster City, which is really small. So it's called 104% to 147%. And in Alameda County, I'm seeing 114% to 204% in both Oakland, Hayward, San Lorenzo, San Leandro areas. So you can see the cooler areas are again along the eastern side. The hotter areas are in the heart of Silicon Valley. Part of that, again, I believe, is returning to workforce. People are now willing to pay a higher premium to be closer to work again. Here's the raw numbers. The previous was compared to the 10-year median. So you can see you have some hot areas and you got some cool areas. And that's the advantage of looking at micro market areas. You're not painting it all with one big brush. If you're looking at Cupertino and Sunnyvale and it's taking 11 days for 3 out of 4 sellers to sell, it's going to be a completely different marketplace than if you go to Morgan Hill at 57 days and you're yet in the same county. Here's price reductions. So the magnitude of price reductions. Blue would be favoring the buyer, which would be larger price reductions. So look again where those large price reductions are, and this is compared to the 10-year median. So these areas are taking more frequent or larger price reductions than they normally do. These areas are taking less areas. Now, in part what happened with the pandemic and people being willing to travel, they weren't willing to pay the premium. Now they're willing to pay the premium, and so prices that were lagging behind in the peninsula are now catching up, and you're seeing that in reduced number of price reductions. So here's the average asking price. This is magnitude. So what are the magnitudes in Santa Clara County? You're going from an increase of 0.2% to a decrease of 2.3% in Morgan Hill. So again, a huge change within each county. In Redwood Shores, Foster City, you went from almost a full percent increase in purchase price to a 2.4% decrease. Alameda County, this should be a bright red. So in Union City, you go from a 0.5% increase to a 2.25% decrease in Oakland. So again, with these shifts within each county, you need to pay attention to what's happening in micro market areas. Here's the frequency compared to normal, and Union City's basically normal. So it probably was supposed to be red. So again, the same concept. This is the frequency of price reductions compared to normal. So less common than normal. Cupertino Sunnyvale is only having 1/3 of the price reductions it normally does. Los Altos is having 3/4. Foster City had no price reductions whatsoever. This is just the number in raw number. So again, you have 0 in Foster City. Cupertino Sunnyvale has, actually it would be bright red. This is 3.8%. I'm really having a hard time seeing the decimal point there. So only 3.8%, so less than 4% of the sellers are doing a price reduction. That would be bright red. 12% would be bright red, and then it'd get to 20%. Yeah, so this is 3.8%. So you can see from 3.8% to 36, that's a factor of 10 difference right there within the same county. You can't pick one number to do a large area, which is why it's important to get a competitive market analysis when you're actually doing an offer or you're listing a property for sale. This is just a global set of numbers. The statistics are a great way of getting an overview of what's going on. Here's the overbidding compared to normal. So way less overbidding than normal, and by way less, basically 2% less, 98% of the overbidding that you'd expect. Now you come over here and look at the magnitude of overbidding. It's still pink because you're still getting for 4% overbids, you're getting 7% overbid in Cupertino. So you can have a much cooler marketplace than normal and still have a hot marketplace. Here's the frequency of overbidding compared to the 10-year normal, much cooler than normal. You can see you're basically 3/4 or lower. Overall, it's 3/4, so 3/4, 80% and 75%. I highlighted the counties and Silicon Valley so you can pick up the numbers quicker. But again, you have less overbidding than normal, but the overbidding is still fairly significant. And the only areas where it's not is Pleasant and 1 out of 4 sellers are overbidding. Same in the San Mateo County coast. But Cupertino, 3 out of 4 sellers are overbidding. 7 out of 10 sellers are overbidding in Pacifica. 8 out of 10 sellers are overbidding in Berkeley and Alameda. Here's the long-term appreciation. And let's see if we can pick this up. It's still here. So Santa Clara County now has 93% appreciation, but look at each one of the micro market areas. The highest percent appreciation is 91%. The only way you can have total county being higher than the sum of all the micro market areas is because the more expensive micro market areas, probably Cupertino and Sunnyvale, as well as Los Altos and Palo Alto, are selling a larger percentage of homes than they normally do, causing the median price to go up. But yet, when you get into the micro market values, the median, you don't have the shift. If you're looking at just Campbell, Cambrian, Santa Clara, Willow Glen, yes, you can have a shift from high expensive homes to low expensive or low expensive to high expensive, but it's much harder and much rarer to do. So these are much more indicative of property values than the county data. That's what I was trying to say earlier in my presentation. Here's the median sold price in the middle number here. The number to the left is the cheapest 10 percentile, and the number to the right is the most expensive. And that way you can sandwich it. So you can see for Silicon Valley, the median is just shy of 1.6, but that ranges from $860,000 to $3.3 million. So now you have a range as well as a midpoint. So 40% of the homes are between 860 and 1.6, and 40% of the homes are between 1.6 and 3.3 million. So it gives you a lot more information than just the median. Here's a summary. I grouped here, instead of alternating, I grouped all the 10-year comparisons on the left-hand side. And you can see for the most part, the blues win on the green highlight at the top. So when you compare it to 10-year median, it's a more favorable to the buyer marketplace currently than it typically is. But then when you come over and look at the yellow, these are current indicators, and it's way more balanced. So even though it's more favorable to buyers than it normally is, it's still a balanced marketplace, which is basically what we're saying, because normally we're in a seller's marketplace. And these are overbid, and they would probably be more red in color, but they're orange highlight because they're lagging behind. Appreciation has nothing to do with market conditions other than how well you've done on your investment. Blue is the least amount of appreciation, which would be San Mateo County. The areas that were close to the workforce had the least appreciation, and some of the outlying areas had the most appreciation. And then you have the price range in each of those micro market areas. Here's the number of offers that were accepted. And the big takeaway here is notice how many 9s there are here. So you're basically the 9th worst year out of the last 10, but I would say more significant than that, come back over this column, and you're basically the 24th worst year out of the last 25 years. And then look at some of the comparisons where you're not quite that bad. You're only off by 2. Next week will probably be number 9. You're only off by 35 or 40. In about 2 or 3 weeks, this will become the worst. I'm not so sure this will become, or not the worst, the second worst. I'm not so sure this will become the second worst. 100's a lot of transactions to fail. That's 5%. And there's also going to be some late reports. This is not the end of the world slide. This is we're only selling 70% or now 85% of the offers that we should be selling. Here's the actual numbers for those that prefer. You can see that the number of new listings is down. That's the holiday weekend. And this is going back over 5 weeks. So, but it does now include Labor Day. The number of active listings is down even more significantly because you had the buyers come in, buy up the inventory. The sellers didn't replenish that inventory. That resulted in a huge drop in the days unsold inventory. If this wasn't a holiday weekend, these are all above my threshold of 5 of paying attention to saying the market's really improving. And instead, I would say this is just showing off the holiday impact. Here are the median days on the market, the marketing time. Median I don't follow because there's not much fluctuation. Average gets impacted by, the transaction that was on the market for a long period of time that sells. I really do like the 75th percentile, and I said it before, I would probably pick the 80 or 85th percentile with my knowledge base now if I had that back in 97 when I started doing this. And then you have the appreciation not only from 2020, but also from 2015. Here now we're getting into three distributions. The first distribution is days on market, some marketing time. The dotted line is where we were a year ago. The purple line is where we are now. We're going to start off a year ago, and we're clearly cooler on the purple line and jump a week at a time and see how you're just sort of bouncing around and really not moving. That would indicate that we'd expect the purple line not to move much from where it currently is for several weeks. Now you're slowing down for the end of the year. Right there's the worst, December 27th, already improving on January. There's sort of the best year. It's already improving when it flattens out on the right-hand side over here. You can see you're now slowing down in May timeframe. Now you're getting up to June. Now you're July, and now you're going to bounce, and you're going to bounce probably for some time. So this gives you an idea of 55% of the sellers. Well, let's use 60%. 60% of the sellers are selling in 20 days. 70% are selling in 22 days. 80% of the sellers are selling in 40 days or less. Or another way to say it is only 20% of the sellers are taking 40 days or longer to sell. And then up here, you have 90% of the sellers taking about 70 days. Moving on to the next distribution, this is price reductions. The same thing. Notice how steep this is over here on the left-hand side. We're taking larger price reductions. This is the fall off. This is 5%. So this would be the 95th, 97.5 percentile sellers. Those are the ones that are taking the largest price reductions. But even up here, the blue line, the purple line, the current data line is one of the worst lines on here. Yes, you're a little bit better over here, but I would say the purple overall is probably the worst line, and you're significantly cooler than you were a year ago. Stepping through, you can see that you basically weren't changing, just like the days on market weren't changing. We basically are in the period of time where the market tends to be fairly stable. Now, when you're November 29th, you're dropping down for the end of the year. To December 27th, we again the worst. There's the peak. There's the peak. That was like February 21st. And now you're cooling down. And now you've almost already cooled down at mid-May. And you're now just going to float back and forth a little bit. Well, I guess it was a little bit more down. So now you're in the bounce. And so now I wouldn't expect this to go for very far until after Halloween. But you're definitely cooler now than you were last year. And the last one is the overbidding. The same concept. You can see a year ago there was more overbidding in price. Here, it's also a little cleaner that the purple line is the worst line on the graph. So you can see the purple, and keep in mind, this is lagging by 4 to 6 weeks. So instead of being the peak around December 27th, the peak's going to be somewhere right around January 21st, January 31st, somewhere in there. So now it's slowing down. Now it's accelerating. Right there is probably the peak for the year. That was back in March. So those were transactions in February. Now you're cooling down. And right about there, you're just going to sort of bounce around. They're not really change much in any one direction. And with that, we've been talking about the Silicon Valley real estate marketplace. We will talk about the Greater Bay Area, 13 counties next. The YouTube channel, you can type in either the long blue URL directly. I can't send you a link, unfortunately, on video, or you can type in the shorter green root URL right here, either one. I know some people are hesitant to use secondary links. If you want to join the presentation Saturday morning at 9 a.m., you type in the green root URL plus the year 2025, meeting codes there, or if you don't want to use a secondary, here is the long Zoom meeting link directly. So there's the password and everything all built in. Again, if it asks for it separately, it's right there for you. And the handout is posted. That's a PowerPoint presentation, about 71 of the slides I go over. You type in the green root URL, the letter H, the year, month, date code. I'm normally not going to put it up there, but here's the Google Drive. So that's where it goes to. Unfortunately, every week the Google Drive link changes, and that's why, to me, it's really not there. And that's an awful lot of typing for someone to do it. So I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers on single agency transactions here in Silicon Valley. My contact information is there for you. I appreciate likes and subscriptions. Let me see if there's any unmuted mics. No unmuted mics, so have a great week. Take care. Bye for now. Moving on to the Greater Bay Area. Here are the 5 regions in the Bay Area that we're covering. You have the Silicon Valley, we've talked about at length, so the city, San Francisco, Marin, and North Bay, Central Valley, and the Central Coast. Here's active inventory. Active inventory is basically down in 4 of the regions. It's flat in the Central Coast. It is down the most significantly in Silicon Valley. Here is the number of offers accepted. It's increasing in all regions except for the Central Coast, which is flat. The most significant increase is probably in the North Bay, followed by the Central Valley, although the Central Valley is flat from just last week, but I would still call that increasing. Central Valley is increasing, but flat for last week. Silicon Valley is going up, and then cities is increasing. Days unsold inventory, the speed of the marketplace is decreasing, which is an improving marketplace, a turnover rate more rapidly. Look at the decreases that we're having in the Central Valley and the North Bay. Those are fairly significant. You went from something like 110 days down to 80 days for a 30-day improvement. You come down to the cities and it went from basically 75 days, now call it 70 days, down to 55 days. And the Silicon Valley has gone from basically 55 days down to 40 days. So across the board, fairly significant improvements. It's faster and the pace marketplace. Marketing time, this is the time it takes 3 out of 4 sellers to sell their property. You have a mixed bag here. You have 2 regions, the North Bay and the Central Coast, both increasing fairly consistently for a long period of time. You have the Silicon Valley that rolled over about 4 weeks ago, and you have the cities that took a significant drop this last week associated with the holiday, and then the flat one is the Central Valley. Price reductions, this is the magnitude of price reductions. This is the average price reductions. So you subtract this off of 100%. So 99 would be a 1% price reduction, 98 would be a 2% price reduction, and 97 would be a 3% price reduction. So most of the areas are having increasing price reductions, which is not good for the seller. The one notable exception is the city, San Francisco and Marin. It went from basically a 2.5% price reduction to a 1.8% price reduction. So a fairly large reduction in the average price reduction. Silicon Valley has been going down for a fairly long period of time. Central Valley has been going down for a long period of time. And by going down, these are increasing reductions in ask price. Central Coast has been going down or larger decreases in prices. So all the areas are getting worse except for San Francisco and Marin, and that's just been a 1-week turnaround. Prior to that, it's been going down. So I would say the trend is for larger price reductions to be occurring. This is the frequency of price reductions. They're clearly increasing in these 3 regions, which is the Central Valley, the North Bay, and the Central Coast. I would call both the cities and Silicon Valley both flat. The cities is probably uptrending a little bit, but I'm willing to call it flat. So 3 up, 2 flat. And that's on the frequency. So how common are price reductions? And it's getting fairly common. I mean, 40% of the sellers are doing a price reduction. That's not quite every other seller. You come down to the Silicon Valley and it's almost 1 out of 5 sellers. So 4 out of 5 sellers aren't doing a price reduction. That's another way of looking at it. Here's the frequency of magnitude of overbidding. This shows the buyer competitiveness. Huge increase just in the last week in the cities, San Francisco and Marin. Slight uptick in Silicon Valley. Now, in order to get sold price, to get the overbid, you have to wait for escrows to close. So this data is, 4 to 6 weeks out of date. It's not telling what the market's doing currently, but it's the most current data that we have access to. You have North Bay going down. You have Central Valley being flat, and Santa Cruz, Monterey being flat the last couple weeks. So definitely a mixed bag. I would say the areas of improvement are potentially Silicon Valley with a turnaround this last week, and clearly an increase in the amount of overbidding in the cities area. It's a matter of whether those will continue. This is the frequency of overbidding. So still half the sellers are getting more than their ask price in both San Francisco and Marin, as well as Silicon Valley, Santa Clara, Alameda, and San Mateo. But the other 3 regions are seeing a decrease in the frequency of overbidding, which is not good for sellers. It's good for buyers. Now in Santa Cruz, just slightly over 1 in 5 sellers, less than 1 in 4 sellers are getting more than their asking price. In the Central Valley, it's 3 out of 10. And for the North Bay, it's 1 out of 3 sellers are getting more than their ask price. So it's still robust frequency of overbidding. Anytime someone's buying a big ticket item and they pay over ask price, there's some sense of urgency that buyers are sensing. Here's the long-term appreciation. Notice the skyrocketing increase here in the Central Coast. That could be market mix. You have areas like King City that are inland that are inexpensive. And then you have expensive areas along the coast like Pacific Grove, Monterey. And if more coastal properties are selling than inland properties, That's going to raise the price, which is going to raise the appreciation factor for the region. Central Valley is fairly flat and homogeneous. Silicon Valley is decreasing, and we've had a situation there where the market mix has clearly shifted, and we had a lot more homes in the expensive area selling. We may be going back to a more normal mix. We still have more homes in the expensive area selling, which brings up the appreciation. North Bay is sort of bouncing around and fairly flat. And then the cities is the least performing and all over the place. And I think that's related to the issues that San Francisco has been having since the pandemic. Here's the sold price. You can see that the most expensive area is Silicon Valley, outperforming the cities, which is an unusual place. You can see prior to the pandemic that never happened. Pandemic is back here in 2020. But coming out of the pandemic, the Silicon Valley has caught up to the median price for the cities. Central Coast has been climbing. Central Coast is now at record high prices, and the only area that is at record high pricing, that's North Bay, is basically flat. And when you start looking at this data, you can start seeing the reason why I think the pricing model is more flat. Look at the Central Valley has been basically flat since middle of 2022. North Bay has been flat. Central Coast is the one exception. San Francisco and Marin is actually lower than their 2022 pricing, and Silicon Valley is sort of right about their 2022 pricing. So clearly the price model where you have a rapid increase of 12.1 and then 0 for the last 3 years is probably a far more accurate model. Here's the estimated payments using the national interest rate for high balance conforming loans, which is higher than jumbo money. So your payments would actually be lower. Your payments would also be lower if you put more than 20% down, or if you qualify for relationship pricing with your financial institution. And here are the raw numbers. The now column is the raw count for this current week for each metric, the percent change from 1 week ago, and the percent change from 5 weeks ago. Here's the chapters that are in the YouTube description below. You can jump to the ones that you find most interesting to you. And with that, we're done. Here's how you get there. I am putting up the direct meeting for Saturday morning at 9 a.m. if people were not wanting to type in the secondary URLs. So that wraps it up for this week. Thanks for joining. Take care. Bye for now.